Okay, we start here for chapter 6 for the introduction to accounting using accounting principle, 9 editions from Wiley Plus. It is the author of this book is Wagan, Kimmel, Turnholm, Warren, and Novak. Okay, so I'm gonna start these lectures. So there's a number of learning objectives for this part, which is in chapter 6. They are described in terms of step of inventory quantities, calculate the CGS using perpetual inventory system as well as using specific identification, FIFO, weighted average, and cost of determination. Explain the financial effect of inventory cost in determination method and determine the final state effect of inventory errors, value inventory at the lower cost and area by value, demonstrate the presentation of analysis and inventory, calculate the inventing inventory and CGS using a predictive inventory system such as FIFO or weighted average in cost formula in Appendix 6A, and then estimating ending inventory using the gross profit as well as retail inventory profits. So what we're going to do today in inventory costing is to determine inventory quantity, taking physical inventory, determining ownership of the goods. So when I was working for, when I first came to Canada, I worked for a company called RGIS, doing mostly inventory calculations. Mostly we are doing inventory costing usually the end of the year, such as December, such as the beginning of the end of the year, such as January or even December, sometimes quarterly. We do quarterly as well, but most of the time we are doing it in late December. So we one of the store that I audit is actually a Home Depot, mostly a retail store in GTA. So we do a lot of physical inventory there. One of the crew that we started is we came in about 8 o'clock before the store close, and then we finished about 3 a.m. in the morning. So we have about 50 of us there. I was assigned to count a screw. Can you imagine how many screw that I have to count them? And also, that's one of those things that help me understand why there's a physical inventory. Basically, you're matching up what is going on in the system compared to the one that is any in the store. Doing a physical inventory, counting all the inventory to make sure they are making the same with the one in the system. Also, even the cost driven method that can be used here for the company usually using a specific indication or using a formula such as FIFO or weighted average. Inventory costing has effect on the financial statement in terms of choice of cost determination method. Okay, it has as well as inventory errors that you need to understand. Presentation analysis, valuing the inventory at lower cost and net realizable value. Make sure in terms of inventory, you're going to value that inventory according to the lower of the cost or net realizable value, so it is not overstating the financial statement. Also reporting and analyzing inventory, presenting inventory in the correct manner in the financial statement. Okay. All right, let's look at the learning objective number 1, which is describe the step in determining inventory quantities. What are those? That the inventory counting, all companies count their inventory at least once a year, must determine amount of value of inventory to prepare the accurate financial statement, and then to determine the inventory quantities involved, taking physical inventory goods on hand as well as determining the ownership of the goods. Taking physical inventory, I mentioned to you, involves counting, weighting, measuring each kind of inventory on hand. So when I was in Home Depot, counting inventory, so we count the inventory of this. There's about 10 of us assigned for the screw department. Just every day we're gonna count the screw. The screw that in the box we can count, but the screw that is not in the box, let's say in the small box that is for the retail, we have to count it by weighting. That's how we do it. By weight, we're gonna calculate it. We have a usage system that calculate that. We put in the SKU number and we count them and then key in using a custom. At the end of the day, they're gonna tally up into the mainframe system and then generate the report. What's the purpose? It is provide strong internal control for accurate inventory count. excuse me, accounting can be done by employee, not really responsible for inventory. This is segregation of duties to make sure there's no a conflict of interest or can be audited. Okay, ensure item count exists by observation. Second, count by another employee. Okay, ensure all item counted only once, nothing is missed. Use a pre-number text. So that's what we do. That is what we do basically. Ensure the item count is observed by observation, and there's always a second count by our colleague in case we missed it. Okay, ensure that all items will be counted once, nothing is misused. Okay. And then the thing of ownership of the good. When we control the goods are transferred to the customer, typing predetermined by examining. When customer has physical possession of goods. When customer has legal title of goods. Okay. General possession coincides with the legal title, therefore control has to be transferred. It's only include inventory owned by the company. Make sure it is inventory owned by the company. If it is consignment, that is not owned by the company. What is consignment? Another company put into our store for sale, but it is not owned by the company. Okay, so the store will receive only a percentage of that sales. The department store is one of those good example of consignment. So determine the ownership of the company. Good insurances example here on board of the public carrier at the count date. Okay, agreed upon the shipping term that can be used to determine whether buyer or seller has legal title of the goods. Look at the FOB point to determine if inventory should be included. Okay, and then determining the ownership of the term of the sale, such as ownership here. FOB shipping point, buyer paid for the carrier. Okay, this is most of the time ownership passed to the buyer here. FOB shipping point. If you example you buy let's say you order a screw from China, so if shipping point it is in the dock in Shanghai, then the ownership passes to the buyer here. But if it is FOB destinations, means that the seller paid the freight cost, ownership pass when it is in the buyer place. Okay, that's the key part. Let's say you buy screw from Shanghai, then that screw is transported using a freight system, then it arrives at your door, then it's going to be ownership transfer by to you. That's called a FOB destination. Well, seller pays the freight cost. Okay, that's a different. Buyer pay the freight cost. There's a two different point: FOB shipping point and of FOB destinations. Okay, FOB shipping point, FOB destinations. All right. What is the consignment good? Consigned goods are goods that are being sold that are owned by others, excluded from inventory consignee who is selling on behalf of the owner and the consigner. This mostly happens in department store. If you go to like Hudson Bay or any FCC store, if you see all those beautiful beauty products such as L'Oreal or any beauty product like I think there's another one, Revlon and other stuff that could be consignor. Okay, as well as perfume, that's also one of those things. Okay, and then look at the learning objective number 2. Calculate the CGS and in the inventory using a strict identification method such as FIFO, weighted average methods, and cost determinations. Okay, all right, let's look at the specific cost determination identifications. Okay, that's the first objective. Track the actual physical flow of goods. Each inventory item is assigned with its cost and used where goods are not ordinarily interchangeable. Okay, all right, let's look at the inventory cost determination cost formula, which is the cost formula. It is specific, it is not always suitable. It is usually using a method called first in first out. We call it FIFO. FIFO means a milk system. Okay, first in. So why I call it milk system? Because when you buy the milk, you have to make sure the first one get out first. If not, it's going to be stale. Okay, it smells no good and you cannot eat that. And the second one is weighted average. Okay, in the old days we have what we call it LIFO, last in first out. But now, 30 years ago, LIFO was still being used. Now, under the IFRS guideline, the LIFO is not being used anymore. Okay, in North America mostly they are not being used. Okay, flow of cost may not match the physical flow on the cost of formula there. Okay, and then FIFO. FIFO means first rule apply at the time of seed sale. First in, first out. I mentioned to you earlier that first in, first out means a milk system. When you go buy milk, okay, for day one, let's say Monday, and then you buy another one milk, day two, Tuesday, you must to get it out first is the one that you purchase on Monday. Because why? If not, it's gonna be stale, it's gonna be smelly. You have to make sure it's get out first. Okay. Second one is called weighted average. Weighted average is the new average cost per unit calculated on each purchase. FIFO assume goods are sold first. Costs at the earliest good purchase are the first to be recognized as cost of goods sold. Costs are the most recent good purchase are recognized as ending inventory, often reflect the actual physical of the merchandise. We're going to look at the example here, ending inventory for FIFO system, January 1, okay, you have here, purchases here, January 1 here, beginning inventory, you get here, April 15 also, and then May 1. This is all these purchases, okay? This is the beginning inventory purchase. January 1 and April 15, these are all the purchases. May 1, you're going to have the sold one, okay? This is the sold one. After the purchase, the inventory get difference there, okay? This is May cost of goods sold. The first 100, which is $10, come here, and the other $25 coming from here, okay? This is cost of goods sold. And then, after that, you get another buy. $300 at $14, okay? But when you get it out, the first 75 first of $12 of the one in April 15, that's the key part, okay? And then the another 275 is based on this 14 bucks later. So the remaining is $25 there, okay? So you got the 400 again purchase, $15. So you're gonna tally up here, total is 6,350 based on 525 units. So that's the key part. So first one here, let's see. Let's recap here. Make sure you understand it. The first one is 100. And then the cost of goods sold is 100. Coming from the January 1 purchase. The 25 of CGS on May 1st is coming from the April 15 purchase. And then the third September 1, 75 CGS coming from the April 15 purchase. And then another CGS September 1 275 coming from the August 24 purchase. That's how it calculates, because first in, first out. The first one has to go out first. The first one has to go out first. A milk system. Alright, let's say look at the weighted average. Assume that it's not possible to measure cash flow inventory based on the weighted average unit cost. The specific costs are mostly popular being used. Weighted average. Under perpetual inventory system, a new weighted average calculated for each purchase. The average of a price goods are sold, total units sold to the cost of goods sold, and remaining costs on hand to determine the inventory. So the logic here, CGS divided by total unit available for sale equal to average unit cost. Excuse me. So we're going to look at the same example before, and the first slide, in the previous slide, we are doing it first in, first out. In this slide, we're going to do the weighted average. So you're going to calculate the first one, the first 100 plus another 100, total of 200. So the weighted average of this will 10 plus 12 become 11. So okay, this the average become $11. Okay. So when you do a CGS based on the average cost, okay. CGS 125, remaining 75. Then you got add up another 300 here. Total become 375 is based on the weighted average. So the average will be cost 13.42. And then you sold CGS 350. Where it's coming from, the 13.4 is based on the weighted average here. Okay, guys, that's how you can calculate there. Okay, that's how you calculate 13.4. This is how they help you calculate 2020 by 200. Okay, 825 divided 75, $11. 25 divided 375, 13.4. 335 divided 25, you got 13.40 cents. Okay, and then the remaining here, you got an additional purchase of 400. Purchase cost $15 on November 27. The average will be 14.91. That because using the logical weighted average cost. So that's the difference on how to calculate the inventory system. Now, learning objective number 3, explain the financial statement effect of inventory cost in the deterministic method. So how are we going to go about that? The choice of deterministic method, cost of failure should be used consistently, enhance comparative statement over time, choose the method that's best correlated with actual physical flow. So use the same method for all inventory having similar nature and use, okay? Okay, what is the financial statement effects? Income statement effect, when the price rise, FIFO produce higher profit. When price falling, opposite is true. Okay, balance sheet effect is the same story. FIFO provides most current valuation of inventory, more closely approximate placement cost. Okay, and then learning objective number 4, to determine the financial statement effect of inventory errors. So this is the most common part, inventory errors. Okay, error in inventory affect both income statement and balance sheet. Why? It's because of through the calculation of cost goods sold. Any inventory one period becomes beginning inventory next period. Error in inventory carry over the following period. So this is very key part. There's a lot of mistakes sometimes in inventory. This is common. Human nature is sometimes we make mistake. Okay, when you do a nature of error here, there's an income statement error. When we overstate beginning inventory, the net effect will be O, overstated, E, understated gross profit, C and E here, okay? Understated will be profit, understated will be profit. So overstated the beginning inventory means the profit will be understated, okay? That's what does it means, okay? Understated the beginning inventory cost. What does it mean? This is going to be overstated. O mean overstated, okay? And then overstated any inventory become overstated here. Understated any inventory become understated here. So that's the income statement effect error. Give you a summary here of the error when you do that in terms of understatement or overstating. So the profit, if overstating beginning, it will be understating. Overstating this ending become understating. Reverse effect, okay? All right, let's look at the next slide. Income statement effects. How do you look at this example? Okay, 2024, we have the correct one here. This is the incorrect one. On the left side, you got the 42,000 here. You got 45,000. The actual one is 25,000, the correct one. But since you have an incorrect one, you're gonna overstate your profit by 3,000. Okay, that's the reason why. Then same issue, you're gonna continue here. You're gonna be understated here. Okay, the combined profit for 2 years is correct because they are cancel each other out. Okay, which will be, but the first 2024 will be incorrect because of the overstated. But after the next following year, it will be the correct because you're going to cancel it out. An error in inventory of one period will have a reverse effect on the profit on the next period. Okay, that's the logic here given to you in this particular example. Okay, in terms of the error in the ending inventory. The idea is to have a perfect calculation in your inventory. The idea, if you have no, if you do not have, then you're going to create the problem, then that's what's going on there, okay? All right, let's look at the balance sheet error. Effect that can be determined using balance sheet error. Asset equal to liability plus owner's equity. This is the logic. This is your golden standard everywhere you go. Overstate in inventory, O. Understate in inventory, U. Okay, this is what again? Net effect, O, U. An error in inventory in one period will cause an error in the beginning in the next following period. Okay, value inventory at the lower cost and realizable value. The next objective number 5. Okay, let's look at the lower cost inventory valuations. I'll call it LCNRV. When realizable inventory is lower than the cost, it is written down to that lower value. Net realizable value means selling price is less than any cost to make the goods ready for sale. Assessed on the items by item basis, the reverse if net realizable value increase before cost of goods sold. Okay, let's look at the learning objective number 6. Demonstrate the presentation and analysis of the inventory. Well, depends in terms of classifying and reporting inventory, depends on whether the company is merchandising or manufacturer. Merchandiser buy and its inventory only one classification use. Manufacturer produces inventory, classify into raw materials, work in process, and finished good. Typically recorded as current asset, but can be non-current if it is sold in 1 year. Okay, and must, in terms of analyzing the inventory, it must be a balance in competing objective. Excessive level inventory leads to a high carrying cost. Too little inventory may result in low sales. Ratio help determine whether a company has too much or too little inventory. So this is the calculation given to you. The first one is inventory turnover ratio, second one is days sales in inventory. Okay, let's look at the inventory turn ratio. What are the logic? Which means equal to CGS, cost of goods sold, divided by average inventory. So the number of times inventory turnover during a given period. The more times inventory turnover, the more efficient the sales are made. That's the logic. Okay, inventory means this number means the higher the number, the more efficient the sales are made. Average inventory is usually the average of beginning and ending inventory. So CGS here given to you, average inventory will there's two of them here. 94,000 plus 112,000 divided by 2, you got 5.6 times. So the key part, the logic here, let me mention it again one more time, is the more times inventory turnover, the more efficient the sales are made. The logic will be CGS divided by average inventory. Now look at the next one, the days in inventory. Days in year divided into turnover. The number of days on average the inventory is on the hand before being sold. Compare over the years. Okay, days in year 365. The standard we always use 365, guys. You don't use 366. Okay, when we do calculation in your exam, it's gonna be 365. And then you have the inventory or turnover. You got the days in inventory. That's the average inventory turnover in this particular logic. Alright, let's look at the learning objective number 7. Calculate the inventory and the cost of goods sold in periodic system using FIFO as well as weighted average in Appendix 6A. Okay, let's look at this one. So, Appendix 6A, we're gonna have this Ingrid Lighting Boutique, date 1 from January 1, beginning with 100 unit, total unit cost $10. Okay, total cost 1,000, total inventory 100, April 15 purchase 100. 12 here, 1200 total cost, you get to 200 here, goes 24 purchase 300, $14 unit cost, 4,200 total cost, you have 375, 27 purchase, 400 units, unit cost 17, total cost 6,000, the inventory is 4,000, you got 12,400. So step 1 is beginning inventory, 100 unit, okay, here you got 1,000 is coming from here, cost of good purchase is 800, where you got this from? The 1, 2, 3, okay, which is 100 plus 300 plus 100. Yes, you got this 11,400. Okay, the CGS available for sale will be 900, 12,400. You add it up. Okay, this is where you get these numbers. Okay, this is CGS available for sale is the same thing, and the inventory 420. What is this answers? Okay, give a couple of seconds so you can understand it. Okay. Logic again, look at this carefully. This is the logic. It's called the ladder step process. You like to the snake ladder process, and when you were young you play that game. It is the same concept here. Okay, alright, look at this logic now. Once you get these answers, the previous slide we're gonna see here the total is 1,200, so you got the total cost step 1 ending inventory, you got 425. Where is it coming from? 400 times 15, which is 6,000, which is using FIFO. Remember, this is FIFO, first in, first out. And then you got 25 is coming from here, okay? CGS, we're going to come look at here, okay? 6050, okay? Remember, this is FIFO, so you're going to calculate the last one first, okay? The last one first. Because you're looking the ending inventory, okay? CGS will be based on the first one, okay? The first one out, okay? Alright, look at the next one called inventory cost formula, periodic system, weighted average, meaning CGS, okay, cost of goods available for sale divided by total unit available for sale 900 equal to average unit cost, which is 13.78. So you're gonna calculate here using the same thing, but you're gonna use the weighted average, which is 12,400 divided by 100. You got this number. Okay, the simplest way will be 5860. Most people like me, I prefer to use weighted average. It's simplest way. You just get the total it out and the average the total number, cost, and how many how much money. So you don't get all those calculation. That's the simplest way. That's the easiest way to do, okay? All right. Objective number 8, estimating inventory using the gross and retail most retail inventory method, expanding B. So as good profit method, not always possible to or practical to count inventory, must be estimated. Sometimes we're going to use estimated. So the two estimate method that I use is called gross profit method. Estimate the cost of inventory by applying the gross profit margin to sales. The calculation will be net sales, number one, step one. Net sales minus estimated gross profit, sales times gross profit margin equal to estimated cost of goods sold. Okay, cost of goods sold here, gonna get estimated cost of goods sold here, cost of goods available for sales here, beginning plus cost of purchase, estimated cost of anything. This is often happens in restaurant. Okay, restaurant use a lot of this because you calculate the food. Sometimes the food has a lot of ingredients, especially in Oriental Asian restaurant. There's a lot of ingredients there, such as spices. You're gonna be different. Spices A, spices B. Some of the Thai restaurant use red curry, green curry, yellow curry. Now, how are you gonna calculate that? So you just take most of restaurants use a system like gross profit method system here. It's much easier to calculate, much simpler. It doesn't take a long time. If you use uh, different method, is where you're gonna calculate more. You can spend more time. So okay, like a good example is good Thai restaurant, right? They use a lot of spices and a lot of different ingredients. That ingredients, the best way they do usually use a gross profit method. And retail inventory method use the cost of retail ratio applied to inventory. Retail determine the estimate cost of inventory calculation. We step here. Step one is goods available for retail sales minus net sales equal to ending inventory retail. Step two, cost goods available for sale at cost divided by total goods divided by goods available for sale at retail. They call it cost to retail ratio. Cost to retail ratio. Okay. Step three, in the inventory at retail times cost of to ratio cost to retail ratio equal to estimated cost of ending inventory. That's how they calculate it. Okay, guys. So look at this retail inventory. This is three steps. Step one, step two, step three. The first one, let me repeat. Any inventory at retail means good available for sales at retail minus net sales. Step two, good available for sale at cost divided by goods available for sale at retail equal to cost to retail ratio. The step three will be ending inventory at retail times cost to retail ratio. We're gonna get estimated cost of ending inventory. Okay, so that's basically conclude this chapter. Then it is copyright is on by John Wiley. So this is we are using this as our classes. So I'm gonna turn off the method this recording. So I'll see you in the next class. Hopefully you enjoy this video.